Hello guys, welcome to PlaybookFX. In this episode, we'll be combining market structure and liquidity. Understanding how liquidity interacts with market structure can help you as a trader make better decisions and manage risk effectively. Before we proceed, please like this video, share your comment in the comment section, subscribe to this YouTube channel and turn on notification bell so as when I release a new video, you'll be the first to be notified. Without saying too much, let's get right into the video. Now, in my previous video, I've explained how you can identify market structure, and I also released another video explaining how liquidity actually works. Obviously, if you go to your chart, you will notice that market does not actually move zigzag like this. Price moves in waves. There are a lot of manipulations and all that. You'll be seeing market moving like this, like this, like this, like this, like this. Now, you'll be like confused that this pattern I drew here is kind of different from what you are seeing on the chart. For you to identify a proper structural leg, you need to understand that price move from internal liquidity to external liquidity. This is what I mean. Like we have something like up push like this, a retracement, and up push like this. Now, if this is happening on higher time frame, like I explained in my previous video, let's say this is our swing structure. Inside this swing structure, you have something like some minor pullbacks, minor structure. Inside this structure, you have structures like this. This is a swing high, this is a swing low. This is an external liquidity. This swing high and this swing low, they are external liquidity. These minor moves inside these swings, these are the internal liquidity. Now, price retracing back down here, price has taken out all this internal liquidity, then price will now go for external. Now, when price push to one extent again, price will come for internal. These are internal here before price now go for external again, because this is now a new external range structure that price will target after taking out all this internal liquidity. If price is moving in this kind of pattern, it will be very easy for trader to make money. But instead, price move like this, price will push up like this, take out this low, push up, come back down, push up, take out this low, push up again. If you check closely what is going on here, in an uptrend like this, price is taking out internal liquidity, they are coming for external liquidity. Price came, look at internal liquidity, then came for external liquidity, again internal liquidity, external liquidity. This is how to mark a proper structure. The one I drew earlier like this is like the basic explanation. Looking at your chart, this is what you actually be seeing. Price will come from external, come for internal, then from internal, price will go for external, from internal, external. So we have mitigation here, mitigation here, mitigation here. Here will now be the protected low, the protected low, the protected low, the protected low. The reason why these areas are the protected lows are because they swept liquidity. These areas swept liquidity, swept liquidity, swept liquidity, swept this low, and then they broke structure. Protected low or a protected high must sweep liquidity and break structure. The same thing applies to bearish scenario as well. Now, if price is pushing to the downside like this, you want to be seeing price taking out liquidity and breaking structure, sweeping liquidity and breaking structure continuously like that. So this is how you identify a proper advanced market structure. Without wasting too much time on this diagram, let's go to the chart so you understand better. First, we need to understand the market direction. where is price heading to? Is price trending to the upside or price is trending to the downside? Now, if you look at this chart here, you'll see that clearly market is trending to the downside. After identifying market direction, then we need to mark obvious highs and lows like that. So let's go back a little bit more deeper. Okay, let's start from here. On 1 hour, we have something like this. We have a high, low, high, low, high, low. Price broke structure here. It broke structure here. Price broke structure as well here. Price broke structure here. Now, if we switch to 4 hour, see, it is more clear on 4 hour because we now have lesser candle. When you're marking your chart and it's not looking clear to you, go to the higher time frame, you see the chart more clearer. If I should go to like daily or weekly now, I'll still be seeing this structure. But it will be more clear on weekly and daily than 4 hour. Now, we've marked our highs and lows. You can see that clearly price is pushing to the upside here. In this scenario, we'll be looking for continuation buy to the upside. Earlier, I explained how price target liquidity. Now, if market is pushing to the upside like this, market will pull back, take out liquidity, and continue pushing to the upside, meaning price has come from external to take out internal. Now, the moment price now take out this internal, then break structure to the upside, we are expecting price to protect this low. We'll be expecting price to print something like this again, come back to this level here, and then continue to push to the upside. Now, if you pay attention to what happened here, notice that when price took out this external here, with this push to the upside, price will print internal liquidity. The price will now come later on to take out before going for this external. Now, this is what happened here. Price came all the way here to take out everything inside here before then pushing to the upside. After price has taken out all this liquidity was taken out, then price broke structure to the upside. This low now becomes a protected low. So I'll be expecting price to come back to this low to take out all this internal liquidity. We're expecting price to take them out, then continue pushing to the upside. Now, price will not come to take all this liquidity now, but in the future, price will still come for those liquidity. Price continue breaking structure to the upside. We swept liquidity. Here, I will not consider here as a protected low. This level did not sweep any significant liquidity like that. If you look at this area, you see that price manipulated this low before breaking structure to the upside. We'll be expecting price to respect this level because this level has swept liquidity and then broke structure. And I'll be expecting price to come for the internal liquidity, fair value gap, recent lows, and price will then go for this external here. Now, moving forward again. Now, after price broke structure to this upside, price came back again, took out more liquidity, mitigate somewhere inside this candle, then broke structure to the upside. This area now becomes a protected area. Price has taken out internal liquidity here, price took out internal liquidity here, and price was pushing to the upside. After price has taken out internal liquidity and price pushed to the upside, we are expecting price to respect this area that took out this liquidity and broke structure. But instead, what did price do? Price only reacted to this area, then took out the low. This area is where that change of character happened. A protected low and the protected high should be protected. So when price break out a protected low, that means price wants to shift from being bullish to bearish. So after price shift from bullish to bearish here, you can see price came back, mitigates somewhere here, break of structure to the downside. Again, we had a break of structure to the downside. Price swept all this candle high, If you go to 2 time frame, you see that this is an obvious area of liquidity, and price swept it, broke structure to the downside. Then this was supposed to be respected. This area was where price was supposed to respect. Then price eventually failed it. Eventually did what? Shift from being bearish to bullish. Remember that price was pushing to the upside here. What happened here was a retracement for price to cool down a little bit before continue pushing to the upside. Now price retracing back down like this. Price is coming to take out all this liquidity. Remember that I said that protected lows and protected highs should be protected, but protected lows and protected highs will not be protected forever. In fact, if price is pushing to the upside like this, and price is taking out liquidity, pushing to the upside, taking out liquidity, pushing to the upside, taking out liquidity. When price was taking out liquidity, price is printing protected lows, protected lows, protected lows. This was a protected low, swept liquidity, broke structure. Protected low, swept liquidity, and break structure. Now, this area that I assume to be a protected low, when price now take this low that was supposed to be a protected low, meaning all the previous protected low are now vulnerable. Price will come for some of them, if not all of them, before price will now continue pushing to the upside. So you will see that we have a strip of liquidity, break of structure. This is a protected low. Price has expected it. We have price swept this liquidity here, then push to the upside to break this structure here. This is another protected low. Now this was the last protected low I'm expecting price to respect. With the moment price now take out this protected low, this area that I was expecting price to protect, any protected low beneath this area, they are vulnerable. When price shifts from bullish to bearish, price will start printing protected highs and taking out low. Protected high, this swept liquidity, then broke structure. This is a protected high. The moment price fails to respect this last protected high, meaning all the protected highs that was printed in this leg will now be vulnerable. Price will take them out, then come from this external. Price shift from being bearish to bullish, started pushing up, and here we have a sweep of liquidity, and we had a break of structure. This was a protected low, and if you look at it, when price came back to this level, price reacted a little bit before it failed. So you keep marking areas like that on your chart, area that swept liquidity and broke structure. And remember that price retracing back down here is for price to come and take out all this internal liquidity, is for price to come and take them out. Then after price finish taking them out, price will start pushing to the upside. This happens on all time frame, both the higher time frame and the lower time frame. It happens everywhere. Just go to your chart and study them. Mark your swing highs and lows on higher time frame. These are structure here. It happens everywhere. On daily, you see that price come for all this internal liquidity to mitigate something inside here, and then price push to the upside, came back again for this internal liquidity, mitigate here, then push to the upside. Price will keep doing that, moving from internal to external. Price will take out internal liquidity to go for the external, internal to external, internal to external. Go to your chart and study all this pattern. If you like this video and you like to see more, please like this video, leave your comment below, subscribe to the YouTube channel so as when I release my next video, you'll be the first to be notified. Thank you and see you in my next video.